So moving on, how do you perform valuation or how do we calculate that benefit? There are three different methods of valuation. All valuation methods can be categorized into three broad categories: present value models, multiplier models, and asset-based valuation models. Present value models are also known as discounted cash flow models. Multiplier models are also known as market multiple models, and asset-based valuation models are simply the calculating the net assets value. So starting with the first one, what we do in present value models is that first we decide that what actually is the benefit. So maybe you decide that benefit is dividend. Then next step is that this is first step. Then next step is that you forecast future benefit. That what will be the benefits in future. So for example, if I have identified dividend as a benefit, I will forecast all future dividends. And once I have all future dividends, then I will calculate the present value of all those benefits or all those dividends to come up with the value of the company. And in order for me to calculate the present value, I will need another estimate, which is for discount rate. So that means in order to perform any valuation using present value model, you first identify what the benefit is, then you forecast future benefit, and then you calculate present value of benefit using a suitable discount rate, and that gives you the value. Now in some cases this may be dividend. If you are using it as dividend, this will be known as dividend discount model. If instead of dividend you are using free cash flow to firm, then it will be known as FCFF model. If you are using free cash flow to equity, then it will be known as free cash flow to equity model. Or if you are using any other maybe residual income, then it will be known as residual income model. So simple idea is that identify what the benefit is, forecast future benefit, calculate its present value, and that will give you the value. No matter what the asset is, let it be fixed income, let it be equity, let it be any asset. Key is you should know what the benefit is and you should forecast benefit and then discount it back. So that means if you have future benefits and if you know the discount rate, then you should be able to calculate value of any asset. This can be any asset. So, and if you know the benefit, then if you are forecasting the benefit, what do you need to know? You need to know the future expectations. So if you are forecasting something, you need to make assumptions about future. What will be the growth? How will the market change? How will the economy change? How will the asset change? And that means that you need to have some expectations. So which means that value is a blend of two major factors, expectations and discount rate. Any change in expectations or any change in discount rate can impact your value. What has already happened in past does not matter, because that wouldn't impact your value. Value will be impacted by two factors, expectations and discount rate. Which means when you are making a valuation model or when you are making a financial model, key importance needs to be paid to two factors, which are expectations and discount rate, because this will impact the value or this will lead to the value. Now the question is, how do you make expectations or future expectations? You will use past data. So you will look at past trends, you will use past data based on which you can make future expectations. Secondly, you cannot only use past data because future is not the same as the past. So you will combine it with some other assumptions. Maybe you make macroeconomic assumptions, maybe you make some judgments, or maybe you take some other assumptions such as changes in consumer trends or productivity or whatever. So that means in order to calculate expectations or form expectations, you need to have past data and you need to have some other assumptions and judgment. So your financial model would contain past data, it would contain assumptions, and when you combine these assumptions with past data, you will be able to form expectations in your financial model. And once you have expectations, then you will calculate discount rate and you will discount those based on those expectations, you will discount future benefits to present, and that will give you the value. This is how the whole financial model works. These are the key pillars of financial model, that is expectations, assumptions, past data, benefit, discount rate, and then value. Once you have value, then you perform scenario analysis or sensitivity analysis to find out that how might the value change. So this is the basic structure. Now the question is that what is this benefit? So if this benefit is dividend, then that will be known as dividend discount model. If this benefit is FCFF, this will be known as FCFF model, and if this benefit is FCFE, this will be known as FCFE model. Any confusion so far? Okay. So now moving on to next step. Now the question is that if I have decided the benefit, let's say I have decided the benefit as dividend, what discount rate should I be using for calculating present value of dividend? Now the question is that what should be the discount rate for calculating present value of these dividend? So remember, if your cash flow is related to equity, you use cost of equity or required rate of return on equity as the discount rate. If your cash flow is related to firm, so for dividends and for FCFE, you will use cost of equity or required rate of return on equity. But for FCFF is free cash flow to firm. For discounting back FCFF, you will use WACC, which is weighted average cost of capital for the firm. What is firm? Firm hoti kya? What actually is a firm? Entity basically, right? But it is a company. It is, but how is that company formed? It is a combination of two capital sources, equity and debt. So when we say free cash flow to firm, it means we are talking about the free cash flow to equity as well as debt holders. We are not differentiating between these two. And when we say free cash flow to equity, it means we are only talking about the free cash flow to these equity holders. We are specifically talking about these equity holders. So this is free cash flow to equity, and this the free cash flow to overall firm would be the free cash flow to equity as well as debt holders. So we will discount free cash flow to equity at the required rate of return on equity, and we will discount back free cash flow to firm at the WACC. Any problem so far? So generally the model that we use in discounted cash flow model, we use FCFF or FCFE. Why? Because dividend is sometimes, so dividends are not sometimes being fully paid. So company may be earning a higher cash flow and paying only a portion of that as dividend and reinvesting rest of it. Maybe there is a company which does not even pay dividends. So that's why we usually use FCFF or FCFE. Now the question is that should we prefer FCFF over FCFE or should we be preferring FCFE over FCFF? So it depends from company to company. So what is the general factor which we look at? How do we decide? So how we decide fundamentally is that we look at the debt to equity ratios, or we look at the capital structure. If a company is mature enough and its capital structure is stable, and we know that this capital structure will remain be the same in future, then we can use FCFE. But if there is a company for which we know that capital structure can change or has been changing, then we will use FCFF. So if the capital structure is expected to change, then it is better to go for FCFF. If capital structure is stable, then you can just go for FCFF. Now next part is that FCFF would in any case cover everything. So even if there is a company which does not have any debt into it, then automatically if you calculate FCFF, it will become FCFE. So that means FCFF is the safer approach to go with, because there will be companies in which you can use FCFE and FCFF both, but there would be companies in which you may not be able to use FCFE. So that means FCFF is a safer approach. So for any company, you can simply go with FCFE, or we usually go with FCFF. Any problem so far? So simply now let's discuss that how do we actually calculate FCFF and FCFE. So FCFF. So first understand what FCFF is. Free cash flow is cash flow from operations minus capex or cash flow from investments. If I have to calculate FCFF, it means I have to calculate all of the cash flows which are flowing into the firm. When we calculate CFOs, cash flow from operations, we subtract interest or we exclude interest from it. So when we calculate cash flow from operations, we subtract interest. Who is paying this interest? Equity holders are paying this interest. And who is receiving this interest? Fixed income is, debt holders are receiving this interest. So that means interest expense is remaining within the firm. It is not an expense for the firm. It is an expense for the equity holder, but it is not an expense for the firm. Why? Because it is going from the pockets of equity holders to the pockets of debt holders, but it is remaining within the firm, which is equity plus debt. So that means that when we are calculating free cash flow to firm, we should not subtract interest. As you have already subtracted it in calculating CFOs, you will add it back. And when you add it back, you take after tax cost of interest. Why do we take after tax cost of interest? Yes. So when you are paying an interest, your profit before tax decreases, and when profit before tax decreases, your tax expense decreases. Now if you assume that you are not paying interest, then you wouldn't receive that benefit either. So you will add up after tax cost of interest. When we calculate FCFE, so simply I can take CFOs minus capex. I do not need to make adjustment for interest, but there is another adjustment which I need to make. So when I borrow debt or when I repay debt, that is a cash flow between equity holder and debt holder. So when the debt is repaid, equity holder is giving it to debt, and when a debt is borrowed, equity holder is receiving it. That means any borrowing is an inflow for equity and any payment is an outflow for equity holder. So you need to make adjustment for that. So you will add up borrowing and subtract repayment, which means adding up net borrowing. So this is how you calculate FCFE, or this is the difference between FCFF and FCFE.
It is based on the assumption that
so this is the difference. Now when we are making financial model and when we start with making the financial model, this means that we should have past data, right? Based on the past data, we will form future expectations. In order to form future expectations, we will need assumptions and judgment. In order to have these assumptions and judgment, we will need more of past data or some forecast or some other data from outside. Once we have the assumptions and using that assumptions, we have made future expectations, and using the past data, we have made future expectations. Once we have made future expectations or develop future expectations using these two, then we will need to calculate discount rate. Once we have the discount rate, we will calculate FCFF based on the expectations. Once we have FCFF and discount rate, we will calculate present value of these FCFF. Once we have present value of all the FCFF, that will give us the value, and then we'll perform scenario analysis or sensitivity analysis, whatever. Any problem so far up till here? Okay, so this is a DCF model or the most used model. Another model is multiplier model. It is a simpler model, and generally multiplier model will help you find out the price rather than the value. So if you want to know what the price will be, it is better to use multiplier model. And if you want to know what the price should be, it is better to use DCF model. So DCF model will help you calculate value for yourself, and multiplier model will help you calculate the price based on the market norms or based on the market trends.